So this lecture will look at incomplete records. By the end of this topic you should be able to recognise circumstances where there are incomplete records, prepare ledger accounts using these to estimate missing figures, to calculate figures using markup and margin. Chapter 22 of your textbook will support. So what are incomplete records? Basically it's where a business does not keep full accounting records. They may have limited records, especially those of sole traders or partnerships, and they'll only have the bare minimum. So things like bank statement, file of invoices sent to customers, file of invoices received from suppliers, a file of bills, till rolls, and a record possibly of the non-current assets that are owned. And it's from these records that it would be normally possible to piece together the information required to prepare a statement of profit and loss or a statement of financial position. However, there are a number of techniques that may be required. There may also be situations in which either in part or in whole the accounting records have been destroyed by a fire, thieves, flood, computer failure, and then it would be necessary to try to piece together the picture of the business from the information that is available. A further element of incomplete records is that a particular figure or a balance may be missing. Typically the inventory destroyed in accidents or drawings will be unknown. Incomplete record techniques can be used to find the missing amount or value as a balancing figure. So some of the techniques that we're going to use is a net assets approach, so looking at the accounting equation that you actually studied as part of your Introduction to Financial Accounting module last term, piecing together a bank and or cash account, using the trade receivables, trade payables accounts, and also markup and margins. So firstly we're going to look at the net assets approach. So it's a particular type of incomplete record situation, and this is where there's been no detailed records of the transactions of the business kept during the accounting period. This may be due to the fact that they've been destroyed or that they were never kept in the first place. The only facts that can be determined are the net assets at the start of the year and the net assets at the end of the year, and perhaps some information about the capital of the business. So looking at the accounting equation, you studied this, as I said earlier, as part of your Introduction to Financial Accounting, and dealing with looking at the system of the double entry. So the basic accounting equation, so assets minus liabilities equals capital, or net assets equals the business assets minus the business liabilities. This can be further expanded to the increase in the net assets is equal to the capital introduced plus the profit less drawings. And it's mainly this third iteration that we'll actually use when we're actually compiling records from incomplete information. So using the accounting equation then, so if the opening net assets of the business can be determined and also the closing net assets, then the increase in the net assets is the difference. Therefore, if any capital introduced is known together with any drawings made by the owner, then the profit for the period can be calculated. Alternatively, if the profit and the capital introduced are known, then the drawings can be found as the balancing figure. So if we have a look at the question Archibald given below. So Archibald started business on the 1st of January 2017 with £2,000. On the 31st of December 2017, the position of the business was as follows. So the business owned a freehold shop and it cost £4,000, some fixtures and equipment at £500, some inventory of goods at £10,300. There was a debt owing by customers of £500. There's £10 in the till, £150 at the bank. In terms of its owings, so its liabilities, so there's a mortgage on the shop of £3,000. There's payables for goods of £7,000, and there's some accrued mortgage interest of £100. Archibald has drawn out £500 for personal living expenses. The shop fixtures are to be depreciated by £50, and some goods in the inventory which had cost £300 can now only be sold for £50. No records have been maintained throughout the year, and you are required to calculate the profit earned by Archibald's business during the year ending 31st December 2017. So this question can be answered by firstly calculating the net assets at the year end. So remember, the net assets is equal to the business assets less the business liabilities. So first of all, we have some non-current assets. So we have the shop. So the shop had a cost of £4,000. It's not to be depreciated, so it's going to have a net book value also of £4,000. We then have some fixtures and fittings. And these fixtures and fittings, they have a cost of £500. And we're told in the notes below the question, these shop fixtures are to be depreciated by £50. So we're going to have a net book value on the fixtures and fittings of £450. So that will give me a total non-current assets of £4,450. So that then we've got the current assets. So we have some inventory. And we know the initial valuation of our inventory is 10,300. However, of these items, some that cost £300 can no longer be sold for that, and they can only actually be sold for £50. So applying IAS 2 from last term at the cost and net realisable value, we're going to devalue those £300 worth of inventory down to £50. So it now means then that our inventory is actually in our accounts at £10,050. So next we have our trade receivables. And our customers owe us £500. We then have our cash and bank balances. So we've got £10 in the cash till, and we've got £150 in the bank account, giving us £160 in total. So if we add up our current assets, we find that we've actually got £10,710. So this will give us a total current assets of £15,160. So from that then we need to deduct our liabilities. So we have our non-current liabilities. And that consists of a mortgage, and the mortgage amount is £3,000. We then have some current liabilities, which consists of our trade payables, which was £7,000, and we have some accrued interest, which is £100. So in terms of my liabilities, I've got £10,100 worth of liabilities. So now to calculate the net assets, we had £15,160 worth of assets, we've got £10,100 worth of liabilities, so we have £5,060 net assets. Now we can use this figure and slot it into our accounting equation to then be able to calculate the profit for the year. So remember that our accounting equation so we've got the change in net assets is equal to our profit plus any capital introduced less any drawings made by the owner. So for the change in our assets then, so we know now at the end of the year we've got £5,060 worth of net assets. At the start of the year, Archibald started his business with £2,000. So the other side of the accounting equation needs to equal. So far we're trying to find the profit figure. No new capital was introduced during the year, and we know from the question that Archibald withdrew £500 for his own expenses. So working that through then, so our change in net assets is £3,060, and that is going to equal whatever our profit is minus the £500 drawings. So rearranging the equation, we find that the profit for the year is equal to 3,060 plus the 500, so 3,560. Now once we've got this position, we can actually then finish off effectively the statement of financial position by drawing up the capital section. So we have the capital at the start of the business was £2,000. We have the profit earned by the business that we've just calculated of 3,560. From that then we can deduct the drawings, and Archibald took £500, and then that will give us the closing capital of £5,060. So as you can see for this question, the incomplete records part of the question is only concerned really with establishing one figure, the profit figure. The question is really about preparation of the statement of financial position.